Felix here. It comes down to this. Your thoughts and your knowledge shape your reality. I was unemployed. I was absolutely broke at one stage in my life, but I was lucky. I became an investment banker, started multiple businesses, and now I live between London, Monaco, and Hong Kong. I have time freedom because my investments work for me, even when I'm not. And in this video, I'm going to teach your brain to invest better and attract more wealth. I will teach you in 4 different parts: mindset, goals, how to pick great stocks, and how to pick multi-baggers, those 10x ones. And at the end of it, you'll be amazed, hopefully delighted that you too can acquire a wealth mindset and real wealth faster than you ever realized, because you now know what to do. I'm going to take you through it step by step right now. So here is part 1. Turn off distractions, get some sort of note piece taking device, and let's get cracking. Number 1, mindset. If you change your language, you change your reality. If you don't like your reality, the first thing you have to do is change your language. You see, you can be in a wealth language state or in a poverty language state. Now, what does that mean? Well, a poverty language state means you say things like, I'm never going to be able to afford that. Look at those rich people. They don't even know they're born. I don't know how to get the money. I'm never going to be able to afford that. I wish I could afford that. It's out of my reach. I see it here in Monaco every single day. Tourists come in and they look at real estate windows on the street I live on, and they shake their heads after they've seen the price tags. They're blocking their mind. Now, with a wealth mindset, on the other hand, you say, I'm having that. I'm getting that. It's got my name all over it. Listen to your language. Take note when you're making yourself poorer, and stop using that limiting negative poverty language. If you don't like your reality, the first step is to change your language, change your mind. Number 2, where do you want to go? If you don't know your destination, how do you expect to ever get there? Right here, right now, decide on your goal income per month. $10,000, $100,000, $1 million, whatever you want it to be. And then use a simple affirmation that one of my mentors, Bob Proctor, taught me. And it's the following: I'm so happy and grateful for the fact that I'm now earning $100,000 a month, or whatever the amount is for you. I want you to read that affirmation 8 times in the morning and 8 times at night. And as you do that, visualize being handed that check, looking in your bank account and seeing the money come in. Visualize walking around in your new home with your family and live that $100,000 a month lifestyle, or whatever the number is for you. Pretend to be there now. See what it looks like, what it smells like, what you're eating, what you're wearing, how you feel. So read your affirmation. I'm so happy and grateful for the fact that I'm now earning $100,000 a month. Mentally repeat and visualize. Rehearse that happening every month, that money coming in every month. This might seem like you're acting, and exactly, that's precisely what it is. But it primes your brain to believe that it is real. It activates your left frontal cortex, which is the genius part of your brain that can actually help you figure out how to achieve that goal and dream. Now, do this mental rehearsal morning and night 8 times. Then make a vision board, either on a cork board or use canva.com, which is what I use, to put in pictures of the lifestyle that your target income a month will allow you to live. What is your car? What is your vacation? What is your home? How can you support your favorite cause or charity, whatever it is that you want to be doing with your life? Then every single morning, after you brush your teeth and have done this, you write down one action step that you're going to take today to get you closer to your goal. It can be something small or something big, but you have to be able to accomplish that goal today. So don't write, I'm going to invest $1 million over the next year. You can't accomplish that today, but say, I'm going to do X task today. I'm going to put $100 into my savings account or my investment account or something on that line. Now, let's get a bit more serious here and move away from the mind, but it's equally important. It's like probably 70% of the work is your mind, and the 30% is the actual knowledge of how to invest and how to pick great stocks. Now, I'm actually running a free webinar tomorrow, which is more on the trading side of life, which can help you potentially earn more income to get there faster. It's completely free. I'll show my entire method and I'll live trade for you and everything else. All you got to do is sign up for that, felixfriends.org/webinar. So if you go there, you'll get full access to it. But let's get into the hearty stuff here. So this file is available to download. I'll link it down below at felixfriends.org/10x. So you have the full workbook. So you can really take this away and study it and also share it with the people you care about. So you've got in here my actual 2023 portfolio. Well, this is not a I'm doing great on my portfolio type thing. I just want to be transparent with you. I think it's always very important, and you can see what the kind of stocks that I own. And some you might be like, oh, okay, Microsoft, I get that, Philip Morris, maybe you hadn't thought of, second largest position. Tobacco pays. Maybe not ethical, but it makes money. So what are we going to do here? Well, we're going to look at how we actually value stocks. Let me just find the first tab here is called Goat Academy Valuation Method, which Goat Academy is our academy. Exactly. So my motto is we don't look for value stocks or for growth stocks. We look for quality stocks. We look for good stocks. But I will show you the differences between the first. But the first one here is quality, because that's kind of the fundamental understanding. So there are a few terms you need to understand, and they are gross margins. Gross margin, it basically tells you how efficient is that business. Can it absorb shocks? Can it absorb inflation, for example? Operating margin then tells you how profitable is the business after they've paid for everything, all the overheads. It tells you a lot about cost control, which is a pretty good indicator of management. But the real one I actually care about is ROCE, and that basically tells you how effective is management? How much money are they making if you take all of the shareholder capital and all the debt together? How much money are they making out of that? That's why I love that number. We look at some real numbers here in a second. Then, is it making money? Is it making cash? It's different. You can have a profitable company that never generates any cash. Really? Yeah, okay. Look at all the people who are running those Amazon businesses, right? So they have to order goods from China or somewhere, put them into a warehouse, and then they ship them out. Now their orders double or triple or quadruple, so they need more inventory. So all the profits that come in go into inventory, into the warehouse. There is never any money in their hands. It's just growth, growth, growth. And that's the kind of retail problem. So we look at two things. One is cash conversion. How easily do they convert and how quickly do they convert profits into cash? And then secondly, free cash flow margin, which is precisely that. As a proportion of all your sales, how much cash have you got left over? Separate from profit. Now, is it a stable business? Leverage is a friendly word for debt, right? So it basically tells you how risky is it, and also tells you something about the volatility of returns. Typically lots of debt, typically not great. Interest cover, what does that mean? How easily can they afford the debt? If the number is very high, it means they've got lots of years of interest that they can pay with today's profits. And where most people jump when they look at companies is straight to valuation, which is kind of like not that important. So PE ratios, profit over earnings, or price over earnings. Earnings stands for profit. It's confusing. I don't know. Confuses me. So it should be PP ratio, really. Price over profits ratio. It tells you valuation snapshot right here, right now, today. Not very useful because share prices go up and down, so it doesn't really tell you that much. I like looking at forward PEs compared to today's PEs. Forward PEs are telling you what's the company worth based on next year's projected profit. And then I look at the difference between the two. And if it comes down a lot, the company gets a lot cheaper in a year's time, then that gives me a positive impetus here. Consistency in profits. No point in having a good quarter. Remember stocks like Peloton, which was a company that glued an iPad to a bike and sold it for a fortune. And that was a business that only worked when people were locked up in their houses against their will during COVID. Once people went outside again, they realized the folly and they stopped buying it and the stock tanked. So is the growth consistent? Is it a quarter or two, or is it every year, every quarter? And then are the earnings per share growing consistently? And the PS, the per share, is the important part, because some businesses are great. They're growing really nicely, profitable, but they're printing shares right, left, and center, diluting the heck out of you. So you own less and less and less and less. And actually, you're never really making any money, even though the business grows. That's a story for a lot of growth companies. And then we look at moat. And you might have heard about moat. Moat is literally what it says on the tin. Imagine you're a castle. The castle is your company. How wide and deep is the moat? How hard is it for the barbarians to invade and steal your pie? So it can be a cost advantage. Maybe you just make stuff cheaper than everybody else. It could be that you are bigger and therefore can make it cheaper. It could be that your clients are so engaged with your ecosystem that's really expensive for them to switch. So Apple, for example, you meet someone who's an Apple user, they'll have an iPhone, they'll have an iPad, their Wi-Fi runs off it, their TV runs off it, they probably have a laptop, and they are not going to buy one Android item, are they? Because it just isn't going to really be compatible, and it's just so expensive for them to change the whole ecosystem. So that's a pretty good moat. So that's a switching cost, and you can of course also have that for business to business business. So ideally patents, brands, government licenses. If you are a monopoly, a utility, only you can supply electricity in the greater New York area or something, then that's a pretty good deal, depending on how easy it is for you to keep that license. So that's kind of the unique edge you have over competitors. So those are terms that you need to know and understand, and we look at some examples here. But yeah, so I generally ignore PE ratios. Basically, you can buy a good stock at the wrong price if you hold it long enough, but you never really get forgiven for buying a bad stock at a good price. That's sort of the way it works. And here's an interesting little example. Let me make this a little smaller so you can see that, just to illustrate the point. So Visa card, if you'd bought Visa in 2012, you would have paid a 23 times profit multiple, which everybody at the time said, that's crazy. That's such an expensive stock. Why would you buy that? Well, if you just held on to it, and this data is from, I think, 2021, it would have dropped to a 6 times multiple because you held the thing for 10 years and profits kept going up, but your share price was fixed, right? You already paid it. So over time, a good company becomes cheaper naturally. And that's kind of the point. Or, look at IDEX, for example, a stock I really like. They make sort of veterinarian stuff. 36x in 2015. If you bought it at that price and held it for 7 years or 6 years, you'd be at 10x, which is a fantastic multiple, right? So you're making a 10% return a year. So I'm not going to run you through all the examples. You can read them yourself, but I want to get into a couple of bits of data here. And if you want to become a great investor, you need to, unfortunately, go through a little bit of data. Like, it's just the way it is. And if you were trained that you were not good at data or something at school or by your parents, they were lying to you. Everybody can manage to understand a few percentages. And I appreciate sometimes mindset gets in the way of that, but it isn't really that difficult. So just play it back a few times, play with the spreadsheet, ping me a message, ask me a question, and we'll get you there. So this is actually an old bit of data from 2021, and I left it in there because, well, it's kind of timely at the moment. Nvidia is in everybody's mouths. Everyone's loving the thing, and we did a comparison of semiconductors chips in 2021, and we were looking at like which one's good, which one's bad. And NVIDIA was the one that we were doing a review on, and we gave it a score of 82 out of 100, which is sort of implying it's pretty bloody good. And how do I come up with that score system? Well, if you go back to the previous tab, I attach a value, a score to each of these. So, a good ROCE would be worth 20 points. The bad one would be 1, and so on. This is obviously subjective, and I also want to show that to you. Analysts, stock analysts, investment banks, everybody makes a subjective decision. There isn't a black or white answer for what a company or a stock is worth. We make this kind of a judgment call, and that's really how we come up with it. So I try to make it pretty simple. So you could maybe also use it yourself. So I put the scores down here for each item, and then I look at compared to the competitors. That's how I do it. Are there good or bad companies? We also have a spreadsheet that makes these kind of comparisons for you in our Patreon. If you want to get your pause on that, felixschwenzer.org/Patreon, it's up there. It's like 50 cents a day or something like that. You don't have to get it like this. It's already free. But if you want to do some digging, that makes it easier for yourself. So we basically looked at NVIDIA, and then we looked at their competitors. And then we look, who's got the best gross profit margin? Well, it was Texas Instruments. So we gave Texas Instruments, in a sense, the highest score. And NVIDIA was very close. So we gave it 4.5 out of 5. 5.5, 5 out of 5 would have been a perfect score, as in the highest. And the similar with operating income, they are the second best out there. Return on capital employed, they are Texas Instruments was better, Qualcomm was better, AMD was better. So they're like the fourth one. So we gave it kind of like a 2/3 of the way there kind of score, 14 out of 20. And similarly here, a cash conversion cycle, as in how long does it take to get cash in when you sell something? 74 days. So this semiconductor industry is pretty bad. If you look at subscription businesses like a Netflix, it'll be a negative number because you prepay them. They don't have to have any outlay for cash, which is great, which means they need less leverage. So, that was a good number, but not the best number again. So we gave it a 7 out of 10, and leverage free cash flow margin, that was pretty good. So that was a 9 out of 10, it was almost the best. And we kind of ran through these numbers like that. Now, one of the things I like looking at with PE ratios is PE now compared to PE in a year or two's time. I did 2 years forward. And you can see it like halved, or was expected to halve over 2 years. And that's pretty bloody good. So the current PE is dreadful because it was 77 times profits, which is kind of crazy. Right now it's even crazier, 100 something. So that's a really, really bad score for me. But then the forward is great because it's gonna halve, which means earnings, profits are outgrowing stock prices. So 5 out of 5. And then the long-term earnings per share trend, 75% of all quarters, they are improving their profits per share. That's pretty good. That's kind of what I look for. You can always have one quarter that's a little off. So 100% is perfect, but 75 is pretty good. So we did a 8 out of 10 or 7.5 out of 10. And then long-term earnings growth rate, as in how much are the profits growing by each year in the long run, not just the one cherry-picked year, but in the long run. And that was 10 out of 10. And then we looked at Moat and gave them a 10 out of 10 because I know a little bit about the NVIDIA business, and they have a particularly advanced bit of technology with their GPUs and so on at the time, plus their brand was pretty strong. This was before the whole AI thing kicking off, but they were already in a position where people were saying, look, their chipsets are just better. So we gave them that score. And that's exactly what I would suggest you do with each stock that you want to look at. Literally do this and do it in a spreadsheet or on a piece of paper. And then you also have a record and you can then review it. I'd review it once a quarter because every quarter you get data. Now, let's sort of drift into part 4 of this video, and then I'll give you a bit of a summary here. And that's growth stocks. Everybody wants to find the 10x growth stock, right? Everyone's like, I want to make 10x because I want to make money really easily. Well, nobody really finds money on the street. So first of all, you can make a heck of a lot of money with quality stocks. And just to give you an idea, so my portfolio has been going up 43% a year compounded. So 15% pre-compounding, 43% if you include the compounding. So over a period of, what is that now, 13 years, it's gone up 538%. S&P's done, is that correct? 159%? I think it's a little bit more than that, isn't it? Let me see. It's a little bit more than that. Let's see. I think it's 257%, isn't it? If I'm not mistaken. I think it's 257%. Don't quote me on that. So these numbers are a little bit off, but the compound growth rate of the S&P will have been a little higher. So I need to update these two. I will do that. But the point is that we do better than the S&P by picking quality stocks, and I think that's something that's achievable for everybody. If you don't have any interest or any time, you probably are not watching this video at this point, in which case, of course, you can buy an ETF. And none of this is financial advice. This is just the views here of an old banker. So, but the point being that if you just put $1,000 a month into your portfolio and you achieve these growth rates, then you would have invested $396,000 and you would have 2.167 million at the end. That's a pretty good return, right? And that's what we're talking about here. You earn $400,000 in your job and you can turn it into 2 something million in 20 years. And you keep doing that, and that number massively grows, and you no longer have to really worry about anything. So moving on to growth. So growth stocks have an added challenge. And I'll show you an example. With growth stocks, you have a lot less data. Now, broadly speaking, the same valuation methods still apply. You still need to look at margins and growth and cash flow and all those things. But it's a lot more challenging because as you'll see in a second, we have a lot less data, and also you need a longer time horizon. So if you bought growth stocks like 2 years ago and then interest rates go up 5%, that probably shaves about 50% of the value of growth stocks, just the interest rate landscape. So does that mean the stock's worse now than it was then? No, not really. It's just you're in a cycle where interest rates have moved against you. Should they come down again, it'll move in your favor again. So you kind of like need to just have a longer time period. And I'd kind of say 10 years is sort of like what you need to be looking at. That doesn't mean you should be holding on to terrible stocks for 10 years. And we'll look at what it makes a terrible or a good stock. So what are we focusing on? What do we have? Well, revenue growth is the one thing I would first of all look at. It's meant to be a growth company. If a growth company does not show revenue growth, as in sales growth, it's not a growth company. Very, very simple. Okay, there might be examples where you are developing some drug that'll cure all ills and cancer and make politicians act sensibly, which could be worth $1 trillion, in which case you haven't got any money until you get FDA approval. So then you haven't even got revenue growth. Low debt is generally a good thing because it means they survive longer. A good cash position, very, very important. Don't underestimate this. Stuff happens where you can no longer access the market to issue more shares or bonds, so you can't really raise money, and then you go out of business. You also want a large addressable market. So the total addressable market, or TAM, should be at least 25 times what they're doing right now. So if you're inventing something and only 3 people in the world want it, even though it's really amazing, then you're never really going to grow much, right? Strong, clean brand, really important. Even if it isn't like the biggest brand in the world yet, you want it to be clean, nothing weird and dodgy. Kat just joined me. She says it's very important. You want tech leadership, so you really want to be up there. You want to be the bee's knees in terms of tech. And high R&D spend. Why high R&D spend? Isn't it wasteful? No, because they need to build that moat. They need to have tech leadership. I like CEOs and founders who are heavily invested. Tesla, Square, Spotify, Mercado Libre, AMD are some examples there. That's an R missing. And this is the most challenging one. And this is probably where you'll say no to most stocks, is are you able to understand the business model and write down 3 reasons why this stock is better than competitors? And just writing down to the moon doesn't count. All right, let's look at an example here. So again, this is 2021 data because I like to have the benefit of hindsight here so we can see what we thought at the time was good and what is and isn't good right now, right? So some of these growth stocks like Neo, Sofa, Palantir, Lucid have suffered pretty heavily. Palantir seems to be recovering, but the rest of them, well, SoFi is somewhat rebounding. So up here, you've got big tech, Facebook, Microsoft, Nvidia, PayPal, Amazon, Tesla, and look at their margins. Facebook, Microsoft, Nvidia, isn't that beautiful? 60% plus gross margins. I love that. And you've got return on capital employed, that ROCE, that is, 20, 30%, really brilliant. Even Tesla's got 12%. So you give them $100, they make $12 a year out of that. That's pretty good, right? If you're thinking of like a real estate investor, if I invest $100,000 and I can get $12,000 in rental income, that'd be pretty amazing. So it's the same sort of thought. And then you look at the growth stocks, negative ROCE. Gross margins for NEO, that is super low because they make cars. So for Palantir, those numbers look good, and that's what we highlighted. They look good, but no income. So no ROCE to look at. Cash conversion, 830 days for SoFi. That seems a bit weird. NEO is good. Anybody have free cash flow? Yeah, NEO did, Palantir did. Lucid, minus 27,000%. That's a nonsensical number. Doesn't tell you anything at all. And if you scroll over, PE ratios are negative. They're projected to be negative with the exception of Palantir, which is on the brink of profitability right now. So the forecast was actually pretty good. But it's not very useful, right? Well, what is worse, minus 550% or minus 45, times? It's just a fairly meaningless number. Whereas we look up here, forward PE ratios, these are real numbers. We know if I put my money into Facebook, I get about a 3.5% return a year in a sense of valuation on that, right? Earnings are. Long-term earnings growth, super, super consistent on the big boys. NEO was good, and the other ones, we didn't have any data. Long-term earnings growth, NEO's was negative, SoFi's was positive, Palantir no data, Lucid is negative. So can you see that it's much harder to come to a decent conclusion on these growth stocks because you haven't got any data points. You just don't know what's going to happen. And that's, of course, also why they should, in theory, give you a bigger boost. And in theory, should make you more money. But there's a risk that they're going to go out of business. And you have to weigh that in. So what is the rule, therefore, for growth investing? Invest small enough so that you don't mind a complete loss. And big enough so it'll make an impact if it goes up. That'd be the first kind of rule for me. Now, there's one more thing that a lot of people overlook and a lot of people make a mistake with in the last 2 years. And that is a little thing called correlation. So sexy, I know. If you go back to my portfolio and you highlight these stocks here, and then there's a website called Portfolio Visualizer. I put the link down below as well. And you can put your tickers in there, literally just type them all in with a space. Hit search. Yeah, there we go. Stocks. I just had to select stocks. Leave everything else untouched. And then it gives you this. It gives you a list of your stocks horizontally and down the side, and says to you how closely they're correlated. What does that mean? How much do they move in tandem? Are they adjoined at the hip? If one goes up, does the other one go up too? So say Microsoft has a perfect correlation with Microsoft. Makes sense, doesn't it? And you would expect it to move similarly with, say, Google, 0.78. So if Microsoft goes up $1, Google goes up 78 cents, Amazon 69 cents, Apple 73 cents. And that's good in a sense, but if your entire portfolio moves in tandem, you're going to have super, super volatile, super risky years. And a lot of people, I think, have seen that being all tech, just the whole thing goes nuts. But by having, say, Johnson & Johnson in here, or Sabre Corporation, or something as sexy as Procter & Gamble, means that, or Philip Morris, 0.22. So now if Microsoft goes down $1, my Philip Morris only goes down 22 cents. So it buffers me. And that's what we call risk-adjusted returns. And that's how professional portfolio managers look at their portfolio. They don't just go, oh, I like it, I'm going to buy it. They look at, yes, but how does it fit into the broader empire that I'm building? Right? And that's really important, that you're not just all on one side, but you are diversified. So I highly recommend you put your portfolio into this. It's a really, really great free tool. So I hope you found this useful. I know it's a little bit of a long one, but I really wanted to just teach you the important stuff. And you might want to replay this a couple of times to really get into it. Download the files, which are linked down below. And of course, make sure you are subscribed to our live free trading webinar tomorrow on Wednesday, felixfriends.org/webinar. I thank you for watching. I thank you for subscribing to the channel if you enjoyed this, and sharing it if you found use of it that you think other people might benefit from too. Learn how to boost your portfolio and your career with the biggest generational shift in like 100 years, AI. Watch this next video. It's the most important one I've ever recorded.